Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 354 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including how fear can drive costly investment mistakes, the latest developments in the tech sector, IPO data that no one talks about, and what 9 straight weeks of gains for the S&P 500 says about future returns. Whether you are tuning in for market insights, planning tips, or just staying informed, there's something here for you. So welcome back, Matthew.
Oh, I'm here, baby. I'm ready after last night.
Couple things. Well, yeah, let's talk about that really quick. You're a big Knicks fan.
Knicks fan, yep.
So they had a huge comeback win last night.
They did. They came down from a 29-point deficit, Mark. They now are 3-1 in the series, go back to San Antonio. And you want to talk about a demoralizing loss for Spurs. You are down 1-2 in the finals. You're away. You're up by 29 points. And you let that slip away.
Were they up 29 in the fourth quarter?
No, they're up 29 in the second.
Okay, got it.
Just to let that slip away, I hate to say it, it's over.
Yeah.
I mean, the Knicks are going to win that series.
Yeah, I got a couple of buddies that are huge Knicks fans, and they obviously haven't been very good for the most part of the past 2 decades. So yeah.
You and me and the Sabres.
Welcome. Yeah, I know, right? Yeah, it's been a long time coming, so it's been 2 good years for us sports-wise.
Take it when we can get it.
That's right. Well, since I think you've been on, there's been a couple of developments as we kind of turn our focus and attention back to the markets, but obviously a little bit of a rocky start for the month of June. So why don't we just go ahead and get right into that? And as always, we're going to review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts and as of the market close on June 10th. S&P 500 index is down 4.1% for the month of June and still up 6.2% for the year. Dow Jones Industrial Average down 2.2% for the month and up 3.9% for the year. The NASDAQ Composite Index down 6.7% for the month and up 8.3% for the year. Russell 2000 Small Cap Index down 2.9% for the month and up 14.6% for the year. And the Vanguard All World X United States Index Fund is down 3.8% for the month, but still up 9.8% for the year. 3-month Treasury rate at 3.79%, 2-year at 4.13%, and the 10-year rate at 4.55%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, JessupWealthManagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the JessupWealthManagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit JessupWealthManagement.com and book your call today.
So the S&P 500 ended its 9-week win streak last week after a volatile trading session last Friday, which I believe was the weakest of the year.
Yep.
What are your thoughts on this? I think we've been previewing to people for a while that we had anticipated something like this to happen just because, like I just said, the market was up for 9 straight weeks, and that's just not sustainable.
Yeah. So if we think about it from this context, the market, when it bottomed, rallied. I'll talk about the NASDAQ for a second because when the listeners see it's down 6.7% month to date, let's focus on that indice. From the market bottom, it rallied well over 30%. So the market's given back roughly a third of that gain. In these types of uptrends in bull markets, that is healthy. And this is normal. And I would throw it out there that if we think of the calendar right now being in kind of mid-June, what are the things on the horizon that are going to provide the next market direction or catalyst? Because in my opinion, underneath the surface, the fundamentals are relatively strong. So we're going to have earnings season at the end of July. So let's spitball this and say we got about 6 weeks until we have the focus come back to the earnings of and fill in the blank company. And in that meantime, we're going to have to struggle with the fact the market has to digest these recent gains. There's definitely some frothiness in some of the different tech sectors, and some of those stocks might come back down to earth. But at the end of the day, I still feel like we're in an uptrend. It's a midterm election year. It's going to be more volatile. Individuals are still thinking that there is a little bit of runway left for the administration to have enhanced activity in the Middle East that is causing oil prices to stay elevated. But I'll say it again, like I said it before, if the Republicans are going to have any good chances in the fall, they're going to have to get oil prices down. And I think as those geopolitical headlines subside, assuming they do sometime over the summer, you'll see the focus come back to the fundamentals, and the market could very likely take its next leg higher. So from my opinion, my thesis for the year, with the way the market's acted over the last couple of weeks, still very much intact, par for the course. Your thoughts?
Yeah, I think it's honestly, very similar to what we saw earlier this year. Obviously, as of right now, on a smaller scale, it's like, okay, the market was a little distracted by what's going on in the Middle East. We had a bunch of sell-offs.
Yep.
And then earnings season came around, and the market focused on what matters long-term for stock returns, which is earnings growth, right?
Yep.
And I think you could have a similar setup coming into companies reporting their Q2 results for this year, like you said, in a couple of weeks. So
yeah, I thought it was going to be one or two scenarios. Either we get a little bit of sell-off and consolidation before earnings, and earnings kind of save the day. That's the case now. Or the other case that was going through my head is the market continues to melt up into those earnings. Then the bar's set really high. Most companies don't get over the bar, and then the consolidation weakness comes in August, September. Obviously, we're getting that a little bit early. So I think it's just normal.
Yeah, agreed. Only other thing we had was obviously there's a highly anticipated IPO tomorrow, and that is SpaceX. It's supposed to be the largest IPO in history. And I talked a little bit about this last week and gave some data on IPOs and what my professional recommendation is on people trading IPOs.
You and I are two different. We're the same on this one.
So, and I know you have a couple data sets that you want to talk about later in the show.
Yeah, they'll be similar probably to what you discussed last week.
Moving on to tweets, articles, and research from this week. First thing I had was a post on X from James Altucher on June 5th. So Jenna will put this up on the YouTube video. This will also be in our show notes. But James says, for people who are worried about the market today, I get it. This stuff is very stressful. And this is last Friday for those people that are listening. That's, it was a hugely volatile day and the weakest day of the year for stocks. So
yeah, and I think weakest going back an actual year on top of it.
Right. Yeah, back into 2025.
Yeah.
So, yeah, I think going back till April of 2025.
Yeah, more than a year.
When it was.
Yeah,
so,
I think you're right.
So he says, I put together a chart of all the times the VIX, the fear index of the market, was up over 30% in a day like today. In the past 10 years, 23 out of 25 instances, the market was higher 1 month later. The only 2 times it wasn't was February of 2020 when COVID hit the economy in March of 2020. What is the underlying message? When people are afraid, they make bad decisions. Do the opposite. Attached is a chart summarizing my results. And as you can see, if you're watching on YouTube right now, the forward 1 month returns are pretty strong, up again 21 out of 23 times with an average return of 2.66%. Does this mean that, from June 5th to July 5th that the market's going to be positive? No, anything can happen.
Sure.
But usually when we get these big VIX spikes or fear spikes like we've talked about in the past, typically at least marks a short-term bottom and things start to steady out from there.
Yeah, it's interesting. You always try to see, what are the narratives in the market for the reason that individuals are blaming a sell-off on. And it seems to me in aggregate, and I can see it to a certain extent, Mark, I keep seeing this narrative about liquidity needing to come up for the SpaceX IPO. Could there be some truth to that? Possibly. It just kind of seems like financial news media people trying to come up with a legitimate reason that's clickbaitish. It kind of was what it feels like to me.
Yeah.
I just think it's a classic. The sector has run really hard, and a lot of stop losses got engaged, trailing stop losses, and it actually might be that simple.
Yeah. Yeah. And again, like I've always said, I don't really care for what the reason is, but we're here, right? And
you always say the price action's what you got to follow.
Yeah, and it's just it's logical in my opinion for stocks to take a breather at this point. Right?
This is a really good piece, Mark. And the instances are quite interesting because this goes back to 2016. Interesting.
Yeah. Next thing I had was a post on X from previous podcast guest JC Peretz. This was on June 4th. Again, this will be on the YouTube page and also be in our show notes, this chart I'm going to talk about. So JC said, momentum thrusts tend to come near the beginning of big cycles, not the end. This quarter, tech just registered one of the largest momentum thrusts ever. Tell someone you think we're still early in this tech cycle and they'll think you're crazy. So what this chart shows for people that might just be listening is the technology spider sector ETF, ticker symbol XLK, and right below it is a common momentum indicator that we use. It's just simply the 2-month rate of change of XLK, right? And as of recent, again, this was back on June 4th, the 2-month change of XLK is over 43%. And if you look at the instances on this chart where there have been these large, short-term, strong performances from XLK, the forward returns tend to look pretty good. So,
great point by JC.
The only other bigger momentum thrust or 2-month rate of change on this chart, other than last week, was at the end of the .com bubble. So take it for what it's worth, but again, if you are someone who's been invested in technology, you've been rewarded so far this year, and it might just not be over yet.
It just makes me think, Mark. I have clients that will ask me, Matt, I just don't get it. The economy seems to be doing okay, is what I'm paraphrasing a client. And I just don't understand why some of these stocks just aren't moving. And they would throw out maybe a local company, and this is not a recommendation for or against, but I'll throw out Procter & Gamble, right? And my response is always the same when this comes up. It's really difficult in the current market environment to get investors excited about some of these companies that are only growing their earnings by mid-single digits. And yeah, what are you going to have to sacrifice with the technology sector? Historically, more volatility. But guess what you get on the surface most of the time? Dramatically higher earnings growth than other sectors of the market. And people want to wonder why it's such a hot sector for a while. It's the earnings growth, just like you've been talking about in the podcast.
Yeah, and I mentioned it in our market update newsletter we sent to clients earlier this month. Last quarter, technology grew earnings by 50% year over year.
Now say it louder for the people in the back. In your opinion, what is the number one indicator of the performance of a stock price?
Yeah, long term, it's earnings growth, right? Now, I think next year in early Q2, when companies are reporting earnings for Q1 2027 versus Q1 2026, like you mentioned earlier, that bar is going to be set really high.
It's a double-edged sword, right? You kill earnings year over year this year. Next year, Wall Street's going to be like, what did you do for me now?
Right. So,
yeah.
Last thing I had was a post on X from Ryan Dietrich on May 31st. He says, as we head into June with the S&P 500 at the highest level it has ever traded at, just remember this is the only month to never see the ultimate peak for the year.
I'm sorry, the data set goes back to what year, Mark?
1950.
I'm making sure I got that right.
So again, since 1950, we haven't had the market peak for the year in June. Again, take this with a grain of salt.
This could be the first data set to do it.
Yeah, again, but if you're one of those people that have been, looking for a buying opportunity or a pullback in the market over the past, let's call it 2 months where, the market was positive for 9 straight weeks, now or sometime within the next couple of weeks might be your shot.
You're going to get swings at bat. Only you would be the one to know if you're going to actually step up there.
Right. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
I won't harp on this too much. My first piece is about IPOs, and I talked about it last week, but there was a piece that caught my eye from, how would you pronounce this properly, Mark? Elliant Capital?
Yeah.
Okay. This was on June 8th, and the chart was really appealing to me. It looks like the underlining source of the chart is TradingView with the timestamp of June 8th at about 8:43 in the evening. And what it does is it shows some of the notorious IPOs that came during the dot-com tech period of the late 90s. And what you're seeing, and I'll verbalize this for our traditional YouTube listeners, it's overlaying a chart of the U.S. Tech 100 versus the Netscape IPO, that brings me back, Yahoo, Amazon, eBay, Global.com. And the illustration here is that every time these IPOs were happening, you had a narrative in the market that, well, if these IPOs are happening, this must be the top. Right? If the insiders are seeking liquidity, this must be it. And not only with the SpaceX pending IPO tomorrow, but the narratives of others like an Anthropic or an OpenAI later this year, this is going to be a narrative. And I just want to throw it out there that just because these companies are IPOing doesn't necessarily mean that we're at a market top. It doesn't. But it also, these things also tend to happen in very good times for the market. So I do think you need to stay vigilant, but it's not just they IPO and the market's going to go to crap. I don't think that's a necessary, thing you can parallel. Your thoughts?
Yeah, I think it's, looking back at history, companies IPO when times are good, when the economy is strong fundamentally,
Yep.
The stock market's doing relatively well.
You sell your house typically when there's a stronger market.
Right, exactly. And, when you look back, I think, 2022 was, before the market sell-off happened in 22, I think people were expecting a lot of companies to go public.
Well said.
Because of that strong run off of the COVID bottom
Well said.
in 2020, right? But then that kind of put a halt to IPOs, and it hasn't been that busy in terms of IPOs since that period of time. So now we're getting back to the point where people are like, hey, market's been good the past couple of years. We're starting to get comfortable again. So yeah, it does make sense to be vigilant. And if we get several more of these high-flying tech companies go public this year, I think it's something to watch.
Well said. Charlie Bolello on the second item of my IPOs had a piece, Mark, on June 3rd, and it just shows the average 3-year annualized returns following the listing of a new IPO. And it's interesting to me, Mark. This data set goes back to 1980, and it's showing that 3 years annualized returns, total returns, after the IPO, so from the first market close, when it first starts trading, IPOs average 6% per year, whereas the total stock market index was 11.8. Similar point to what you made last week. I just want to throw it out there. Tread carefully.
Yeah, and again, when these public offerings happen, there are insiders or company founders or early investors that were, within the first days of getting the company off the ground or the first couple of years that want to get their money out.
Yeah,
right? And
absolutely. They've been waiting for a while, I bet.
There's going to be a lot of those type of people selling to the public, and it just makes for some pretty volatile trading days over the first couple of days. But I think the data is abundantly clear that, IPOs typically don't do as well as just the broader market over the first couple of years of trading.
There it is. My second piece is a post on May 26 from Dividendology. And this was a really good post. And what we are showing here is a piece that shows in the late 90s where some of the valuations and market caps were for a lot of these high-flying tech stocks. Now, why am I talking about this? Right now, there is a lot of talk, especially about the semiconductor sector, about valuations, okay? And I'm going to give you an example. I had a client say to me, Matt, don't you think, and I'm not going to say the name, XYZ company is a bit overvalued right now, okay? And I pointed out, not to get too technical for some of our newer listeners, but this individual was sophisticated. And I responded with, I know the forward PE is roughly 23. Okay. So let's go over some of where these PEs were in the late 90s. Because again, I got to hit this home. I'm kind of sick of people talking about the relation of tech at the end of the 90s and tech now. So I'm going to now got a new data point. Cisco Systems still trades. Ready for this, Mark? And this was March 7th of 2000. This is near the peak. We're within a month of the peak, okay?
Right.
Market cap on Cisco was $452 billion. That's big back then, right?
Huge.
The PE on this stock at that time was 148 times earnings. In plain English, if back in March of 2000, you were wealthy enough, you were Elon Musk rich, and you can buy all of Cisco, and their earnings stayed exactly the same, it would take you 148 years to make your money back. Okay? Next, I'm going to go over AOL Time Warner, hot stock back then. Okay?
Yep.
PE on that bad boy, 217. Oracle, they're another oldie but a goodie.
Right.
PE 152. Nortel Networks, that takes me back, 105. Sun Microsystems, which is now part of Oracle, a PE of 119. EMC, which is now part of Dell, PE of 115. JDS Uniphase, that was a hot semi name, 668 times earnings. Qualcomm 166, Yahoo 623. 623. So here's my message. Are there stocks out there right now that are trading at literally 100 plus PEs? Guess what, people? There is. And are those stocks going to grow into those valuations? I don't know. But when we start lumping in just all tech stocks and that this is, 99, 2000 all over again, when we are looking at valuations and balance sheets, as a whole, the comparison is not holding up. However, there are some names out there that are at some lofty valuations. Any other comments before I move on?
No, I don't think so. I just think it's noteworthy to point out that people have been saying tech has been in a bubble / overvalued for the past 10 years.
Yes.
Right.
So kind of like emerging markets. It's this year, Mark.
This year. Yeah. It's this year.
It's this year, buddy.
Year,
yeah.
right.
This is going to be our year.
Unbelievably hard to time this stuff, and just think back to, 2020 during COVID when the market recovered. What worked for those first 6 months? It was all these non-profitable tech companies. And if you look fundamentally on paper, you're like, well, these things are, it's a POS, right? And,
As my kids would say in the GRU, it's garbage.
right, yeah. But at the end of the day, those are the companies that were performing. So, valuations to me, long term they matter, but over shorter term periods of time, you can kind of exploit people's opinions on valuations if they're like, oh, I'm never going to touch a non-profitable tech company yet. Oh yeah, well at one point Amazon was non-profitable.
Well
at
said.
one point Apple was not profitable.
Well said.
And look what they turned into today.
Well said.
So,
my last piece is the biggest 9-week gain since 1950. Okay, so we are coming off number 16 in history of the greatest 9-week gain for the S&P 500 mark. This data set, just so we time check this, is from Charlie Bolello at Creative Planning, and the date on this is May 31st mark. I'm going to throw out some of the statistics of history of these 9-week upthrust in the market. 3 months later, on average, 9.2% higher for the S&P. 6 months later, on average of this data set of 20, 12%. 1 year later, 24%. 2 year later, total return, 30%. And again, the success rate, the only data set of this that was negative 1 and 2 years later was 2001. Okay? So I just want to throw it out there that, hey, these corrections are normal.
yeah,
It's the lifeblood
and when you
of
have
a uptrend, the
you
bull
know,
market.
these big, strong several week gains, many people might think that that's the top, but I think the data is pretty clear that it's usually not. It's that, the old adage of strength begets strength, right?
Yeah, you're right.
So moving on to the financial planning topic of the week. This was an article from Think Advisor on April 7th by Dina Weisenberg-Brin titled Errors Beware. 42% spend inheritance within a year, study finds. So Dina wrote a really nice article. I just want to read a few of the things that I thought were interesting. So she said that one of the more surprising studies I came across recently looked at what happens when people inherit money from loved ones. So researchers from Texas Tech University and the University of Alabama found that 42% of heirs age 50 and older had spent their entire inheritance or had their net worth fall back to pre-inheritance levels within about 12 months of receiving it. What makes this finding especially interesting is that inheritances were spent faster than other types of financial windfalls, even after accounting for the size of the inheritance. Researchers believe this happens because inheritances are often viewed as death money. The emotional impact of losing a loved one creates what psychologists called mortality salience, meaning that the inheritance becomes a constant reminder of that loss. For some people, spending the money quickly may subconsciously help them distance themselves from those difficult emotions. The study found that people generally fell into one of two camps. 43% preserved the entire inheritance, viewing it as part of their family's legacy and that should be passed on to future generations, while 42% spent it all relatively quickly. Interestingly, only 15% took a balanced approach by saving some and spending more. So, want to get your thoughts on this. I just thought it was interesting. I wouldn't have thought that people blowing through their inheritances would be at a 42% run rate at age 50 or older. That shocked me a little bit.
That seems very high in my opinion for what I see boots on the ground. Continue though.
But what have you seen over the past several years and trends, I guess, in this area?
I'm going to spitball my own stats on this between those three topics. In my opinion, what I see is about roughly 20 to 25% spend it within a year. And I would argue the other is kind of split, let's say the remaining 80%, half of that don't spend a single dime of it. And the other half, they typically pay off immediate debts and then are disciplined with the rest. And I would actually argue that seems to be the average of what I see more often than not. So this doesn't necessarily surprise me. And I think a lot of it has to do with two things. One, I always tell parents at the end of the day, when something happens to you, if you want to control the distribution of this wealth, if you're not confident it's going to be properly handled in your eyes, there are things that you can do from an estate planning perspective to set up the next generation for success, right? There are things you can do. There are some mindsets that, well, I'm not here anymore, so let the chips fall where they may. And I definitely understand that side of it as well. I come at it from this perspective. I know how hard my clients have worked to save and grow these assets. And when I see inheritance spent that quickly, this is not a judgment statement, Mark. It is a little disheartening knowing how hard that parent has worked to save that. Does that make sense?
Yeah. Yeah. And I think it's
not a judgment statement.
You hit the nail on the head. It's going to be different for everybody. Some parents are, legacy planning is vitally important to them, and they want to have a say in where their money goes and how their kids can spend it and how their grandkids can spend it. And then there's some people that are just like, I don't really care how they spend it, right? So if you are one of those people, though, that do care, you got to plan for that.
You do have to plan for that. And there's a lot of resources these days. The last point I want to make is I get in front of clients and this topic comes up, Mark, and I talk about their ability to name a successor trustee who could be a trust company. I'm not talking about the traditional banks that are coming into your head right now. I'm talking about some really good independent trust companies. And a couple decades ago, they were unobtainable. They were unaffordable for the average individual. They're not anymore. So I just want to throw that out there.
Yeah. Yeah. And there's so much free information online today, and it's not hard to find an estate planning attorney, it's locally in your town just to talk to about this stuff.
And you need a referral, call our office.
Yeah. So that's all I had, Matt. Anything else before we leave it there for the week?
My last comment, and I'm saying this to hopefully ward off negative juju. The last decade, I feel like the last 2 weeks of June have been generally unfriendly to me, market-wise. Okay? So I want to get ahead of this. Everyone send me your good karma. I want the last 2 weeks of June not to be like the last decade.
You must have had some pretty bad 2 weeks of June, because that's pretty specific.
It is. I just feel like the last 2 weeks of June market-wise, and last year was a little bit of an anomaly with that post-tariff rally. It just hasn't been great for the market.
Okay.
Let's see if we can turn this frown upside down.
I love it.
I
love it. We will leave it there for the week, and thank you for listening to episode 354 of the Independent Advisors Podcast. Catch us next week for episode 355.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.